While most everyday investors look at the charts and assume that Cardano is completely dead, a tiny group of ultra-wealthy entities is holding a massive, highly speculative play. See, the data shows that the top 1% of holders are aggressively cornering the supply, locking away millions of tokens while retail investors dump their bags in frustration. Now, this isn't a random speculation, no. See, these elite players are tracking a fundamental upgrade in institutional infrastructure that the broader market doesn't even know exists. Right now, Cardano is navigating one of the most structurally complex periods on its entire operational history. You see, the native token is trading at a depressed valuation of around 25 cents, experiencing a heavy 89% drawdown from its all-time high, while Bitcoin has been testing the $80,000 threshold and Solana has been bouncing back towards $90. ADA has shed 71% of its market value over a brutal 9-month stretch. So this prolonged drawdown trajectory has explicitly branded Cardano as a permanent underperformer to the average retail observer. But behind the scenes, a completely different reality is unfolding. See, wallets holding at least 1 million ADA have aggressively absorbed hundreds of millions of tokens, bringing whale concentration to a historic 67.4% of the total liquid supply. Now, the elite 1% are pulling massive amounts of liquidity directly off of active exchange order books for cold storage. They aren't looking at basic price charts. They are accumulating because they understand the secret plumbing required to bring billions of dollars in institutional capital onto the ledger. To understand what the hidden 1% are actually anticipating, we have to look directly at the hidden war currently being fought inside decentralized finance. Now, the ultimate barrier keeping Wall Street from deploying billions of dollars into protocols like Cardano has always been a structural vulnerability in how blockchains read data. Now, traditional networks, they rely on slow, legacy oracles that only update financial prices every few minutes, leaving a massive window of vulnerability wide open. Now, when an oracle updates slowly, it creates a fatal lag between the real-world market price of the asset and its recorded price on the blockchain ledger. Now, malicious arbitrage bots consistently and continuously scan the network, hunting for these specific price discrepancies. Now, the moment that a real-world price moves before the on-chain oracle updates, these automated bots strike, executing hyperfast trades that systematically drain protocol collateral. It is a highly sophisticated form of financial theft that retail investors completely overlook. Now, this precise structural vulnerability is why major institutional funds have historically refused to touch decentralized finance. They refuse to expose their capital to environments where lag allows automated bots to siphon away millions of dollars in liquidity. Now, the ultra-wealthy whale cohort, they understand that utility, at least until this exact oracle latency issue is permanently resolved, large-scale enterprise capital cannot enter. Now, this hidden vulnerability is the real reason that total value locked has remained suppressed across the entire blockchain space. The stakes of this legacy war become incredibly dangerous when you look at the mechanics of the synthetic assets, like those built on Cardano's Indigo protocol. Now, synthetic tokens are designed to mirror real-world assets, such as gold, stocks, and fiat currencies, entirely on-chain without relying on traditional bank custody. Now, for these complex financial instruments to remain stable, the protocol must maintain an absolute, unyielding mathematical balance between the synthetic asset and the underlying collateral supporting it. You see, if a synthetic token tracking a real-world stock experiences a sudden, violent price drop in the traditional markets, the on-chain protocol must react instantly. Now, in the networks, at least if the network's oracle takes even just a few seconds to report that price drop, a catastrophic lag occurs. Arbitrage bots will immediately buy up the underlying synthetic assets on-chain and redeem them for the undervalued collateral, leaving the protocol entirely under-collateralized. Without sub-100 millisecond latency, these protocols face total systemic collapse because periods of high market volatility allow for arbitrage. And this is exactly why the 1% are aggressively hiding their accumulation strategies, while retail investors panic over short-term price action. See, the elite cohort, they realize that synthetic assets cannot scale to a global level on slow legacy data feeds. They are actively positioning themselves before a massive paradigm shift, knowing that solving this technical bottleneck is the ultimate prerequisite for actual real-world asset tokenization. So, that raises a question for you. How do you view this hidden battle for ultra-low latency data? Do you believe resolving this oracle bottleneck will finally convince institutional giants to deploy billions into Cardano? Or will retail capital always prefer faster, more speculative chains? You can let me know your theories and thoughts in the comments down below. The absolute turning point for this entire ecosystem has quietly arrived with the official mainnet launch of Pyth Pro on Cardano. Now, this is not just another standard technical upgrade. It is a highly specialized infrastructure deployment designed specifically to meet the rigid demands of institutional decentralized finance. You see, Pyth Pro completely eliminates the old Oracle model, introducing an entirely new architecture that operates with sub-100 millisecond latency. Instead of relying on third-party scrapers to pull data from public web pages, this advanced framework sources its financial data directly from first-party institutional originators. See, global market makers, major stock exchanges, and elite trading firms feed their real-time price feeds directly into this network. Now, this direct pipeline completely closes the latency gap, delivering highly precise, lightning-fast price feeds that update multiple times per second. See, by bridging sub-100 millisecond data directly onto the ledger, Pyth Pro effectively disarms the malicious arbitrage botnets that have plagued decentralized protocols for years. Now, the fatal price lag is entirely erased, making it mathematically impossible for automated exploiters to front-run the system and drain protocol collateral. This creates the ultra-secure, institutional-grade environment that the world's largest asset managers have been waiting for before moving their liquidity on-chain. The hidden 1% are tracking these architectural upgrades because they know that solving Oracle latency is the ultimate gateway to real-world asset tokenization. Now, Wall Street doesn't really care about meme coins or speculative trading volume. They care about tokenizing trillions of dollars in real estate, corporate bonds, and traditional commodities. To move these massive asset classes onto a blockchain, institutions require Tier 1 data that updates at the exact velocity of traditional global markets. Now, when a network successfully pairs sub-100 millisecond latency with a highly secure ledger, the structural barriers to institutional adoption completely dissolve. Real-world assets can be tokenized, traded, and lent out globally without the risk of Oracle exploitation or systemic protocol collapse. Now, this massive breakthrough directly precedes an unprecedented exponential expansion in total value locked, completely shifting the economic reality of the ecosystem. This is the exact strategic foresight that the elite whale cohort are hiding from the broader public. While everyday retail traders are distracted by short-term price drawdowns and social media noise, the smart money is quietly front-running the plumbing. See, they understand that the infrastructure being deployed right now is the foundation required to turn a historic quiet ledger into a dominant powerhouse for institutional capital settlement. And if you want to track these infrastructure upgrades, whale movements, and structural supply chain dynamics in real time alongside a community of active on-chain researchers, well, come and join our free educational Discord. The link is in the description down below, and you can consider this an open invitation. The financialization of these advanced infrastructure upgrades is being heavily accelerated by an impending regulatory countdown in the United States. The absolute critical prerequisite for the SEC to consider approving a spot cryptocurrency ETF is the existence of a highly regulated futures market. Now, this vital requirement was officially satisfied on February 9th, 2026, with the launch of the CME Cardano futures. Now, based on strict historical precedents established during the Bitcoin and Ethereum approval cycles, the SEC mandates a minimum 6-month seasoning and surveillance period for a new futures market. Now, for Cardano, this crucial regulatory threshold mathematically arrives at August 9th, 2026. The moment that this date passes, spot ADA ETFs become formally eligible for listing under streamlined generic standards, bypassing separate, protracted rule changes. Now, I do have to just pause here for a quick second to let you know that I'm not a financial advisor. This video is for informational and educational purposes only. The crypto market, it is volatile, and you could genuinely lose everything that you've invested. So it's very important that you do your own research, because at the end of the day, your money is your responsibility. Now, tectonic asset managers are already aggressively maneuvering behind closed doors. You've got Grayscale has actively updated its registration forms to convert its massive private trust into a publicly traded spot ETF under the ticker GADA. Under the streamlined review timelines, the SEC faces a hard legal deadline of October 23rd, 2026, to issue a final approval or denial. Asset managers like Van Eyck, Bitwise, 21 Shares, and Canary Capital have also filed, creating immense institutional pressure. And all of this raises a question for you. Do you think the arrival of a spot ETF will trigger a historic supply squeeze that completely validates the whale accumulation, or will traditional institutions entirely ignore the product? Let me know your predictions in the comments down below. While Wall Street prepares for the regulatory countdown, Cardano has simultaneously achieved a massive engineering milestone by entering its Voltaire era. Now, the network has successfully transitioned into a state of absolute unbreakable decentralized community governance. The founding entities voluntarily stepped back, handing over the protocol's multi-million-dollar treasury and parameter keys directly to the community. CZ control is now held by the governing body consisting of delegated representatives, stake pool operators, and community-elected constitutional committee. No single entity can unilaterally alter the protocol. Now, this framework was recently put through a brutal real-world stress test when unexpected committee registration or resignations dropped the active membership to 6. Plunging the ledger into a temporary deadlock because the system had a strict minimum size of 7 hard-coded into its parameters. But instead of collapsing or relying on a central boss, the decentralized community rapidly mobilized. They coordinated an emergency snap election, voted in new consortium called Cardano Kruya, and permanently patched the underlying protocol parameters to ensure future operational resilience. The machine fixed itself completely on-chain, proving to institutional observers that the network possesses the long-term stability and political sovereignty required to host global financial systems. To ensure this new institutional capital can flow without friction, the developer ecosystem has been executing massive code updates at a relentless pace. The network consistently ranks third globally in absolute annual GitHub commit volume, Over the trailing 12 months, developers have logged an astonishing 17,000 commits across hundreds of distinct repositories, basically building out a highly specialized scaling network. Now, a major driver of this development growth is Aiken, a highly accessible programming environment that has driven a massive 40% increase in new application deployments by completely eliminating the friction of older systems. Right now, the core community is hyper-focused on the mainnet deployment of the Van Rossem hard fork, which will transition the blockchain from protocol version 11, or from 10 to 11, lowering execution costs for complex institutional smart contracts. Now, for those who want to truly master all these concepts and understand the deep technical architecture of smart contracts and get structured learning instead of just watching videos on X or on YouTube, you can actually head over to cheekyschool.com. See, we have some completely free courses to get you started, plus you'll find a 50% off discount code for any of the paid programs in the description down below. In a powerful demonstration of strategic focus, core engineering teams made the massive, unexpected decision to completely halt development of the 𝗗𝗶𝘀𝗰𝗍 node alternative and cancel their proposed tier pricing fee mechanism. Abandoning a well-funded project mid-development might look like a failure to an outside observer, but it was driven entirely by an intentional and internal breakthrough regarding Ouroboros Leios. You see, Leios introduces a fundamentally parallelized model for transaction processing, conceptually pushing the network towards thousands of transactions per second by completely decoupling transaction endorsement from block production. See, engineers, they realized that continuing to fund the 𝗗𝗶𝘀𝗰𝗍 node would introduce massive, obsolete technical debt the moment that Leios went live. They cut their losses and returned 4.1 million ADA directly back to the decentralized treasury. Now, this extreme focus on ultimate horizontal scalability is exactly why the hidden 1% are aggressively cornering the supply. See, they recognize that when you pair the parallelized kind of throughput of Ouroboros Leios with the sub 100 millisecond latency of Pyth Pro, the network transforms into an unassailable infrastructure machine. It completely resolves the blockchain trilemma, right? Creating a highway ready for processing massive institutional volume. The rapid convergence of ultra-low latency data feeds, advanced parallel scaling, and imminent spot ETF deadlines have created a massive asymmetric trap for everyday retail investors. Now, because 67% of the liquid supply is securely locked in whale wallets and another 58% is staked across the network, the actual liquid float available on exchanges is incredibly thin. See, when an asset has an exponentially thin liquid float, any sudden injection of large-scale external demand creates a violent, exponential price spike because there simply isn't enough tokens available to meet the buyers. Now, the everyday retail investors who are currently dumping their tokens out of sheer exhaustion are handing their liquidity directly to the elite 1%, completely blinding themselves to the structural supply shock that is building on the horizon. To safely navigate this volatile environment, you must ensure that your personal infrastructure is completely bulletproof. Now, to hedge against sudden platform outages or exchange liquidations during a massive market move, you must implement a strict exchange redundancy strategy by spreading your capital across multiple venues like Binance, Coinbase, Bybit, Kraken, BitGet, Blowfin, and many others, signing up for as many Tier 1 platforms as possible to keep your options open. And if you prefer to hold your own keys, you can seamlessly stake your ADA natively from your cold storage without any lockup periods whatsoever. And I invite you all to support the independent research here by staking your tokens to our official pool under the ticker CHEEK, CHEEK, where you may maintain absolute custody of your funds. More details can be found in the description down below. And all of this raises another question for you. Given the massive concentration of wealth by the top 1%, do you believe this thin liquid float will lead to a historic aggressive upward repricing of the asset? Or will the network fail to capture the institutional volume required to trigger the squeeze? Let me know your predictions in the comments down below. The on-chain data points to an undeniable picture of a network experiencing a severe historic divergence between its intrinsic technological infrastructure and its external market valuation. Now, from a pure protocol perspective, Cardano has arguably never been healthier or more secure. It has successfully automated its own governance, eliminated developer friction, and deployed the low-latency Oracle infrastructure required by global enterprise capital. And yet, the second-order financial realities cannot be ignored either. The toxic combination of depressed retail sentiment, low fee generation, and compressed staking yields has masked the massive structural upgrades occurring behind closed doors. The elite 1% have used this widespread market exhaustion to quietly execute an unprecedented cornering of the liquid supply, waiting patiently for the ultimate narrative shift. You see, Cardano's macroeconomic fate now rests entirely on the convergence of these imminent catalysts in the latter half of 2026. If the mainnet upgrades successfully revitalize liquidity, and the August regulatory gateway welcomes a wave of institutional spot ETF capital, the resulting supply shock will force a violent, aggressive upward repricing of the asset. The hidden play of the top 1% will be completely validated, leaving the exhausted retail crowd permanently locked out of the loop. For now, you can click the video that's loaded up on the screen, and I will see you all over there.